Good morning, everybody. How you guys doing? I hope you're all doing okay. I mean, put on your audio so at least I can hear some voices coming up.
Good morning.
Good
Yes,
morning.
Good morning.
Hi. Morning.
oh wow, you guys sound amazing. Sounds like a fantastic choir. Good
Morning.
morning. How are you guys doing?
You're doing all
Thank
right.
you. We're good.
Excited to have you.
Fantastic. So
Good.
what's the money pain point? Throw words at me. When you hear money, what are you thinking? What's the pain point? What's the aspiration? There's no right or wrong answer, by the way. No, money is a personal conversation. I'll tell you what I think when I hear about money. The thing that's always in my mind is I really want to have money when I'm older. I don't want to be working and having this lifestyle that I'm enjoying, and then in my 60s or in my 70s, I don't have regular income. So that's the thing that nags at me. And then I'm also born again. So I know the Bible says a good man leaves an inheritance for their children's children. I know I'm not a man, I'm a woman, but I take that to mean both sexes. So I always ask myself, how will I create wealth for myself to be able to live in the latter years? And then other question I ask is, how will I leave something for my children and my children's children if God blesses me to that extent? So those are the things that go through my mind. And then also in that, also appreciating what do I do in terms of being a good steward of the resources that come my way, and balancing the fact that I'm in a world that has a lot of pressure, but learning to also know that I should trust in God because He's the source of wealth and all our strength, but also knowing that I have a part to play. So those are the things that sort of play out in my mind when I'm having a conversation about money. I'd like to hear maybe one or two thoughts when we think about money, and especially from the bulk of you, because you're running businesses. So I think that's a constant conversation on a daily basis. What do you guys think when you're thinking about money? What does money do for you, or what would you want it to look like for you?
I can see Donald has written and said to earn more than I spend.
Yes.
Then Lisa says to have financial freedom and educate my kids on investing.
Okay, fantastic. Is there one more? Okay, there's no more. I thought I'd hear something like we want to build wealth. I mean, this has been a mentorship class from Optimen. How do you build wealth for yourself and your family? Okay, all right, no worries, no worries. And what about for your businesses? What does money mean for your businesses? So how do you think about it? Or are your businesses a way to making money?
Deborah says, I would like money
Yes.
to work for me, especially in later years.
Okay.
Then Lynette says, how to make money from my business. Then Arjuna Wilson from Uganda says, just an exchange of goods and services with the aim of tomorrow in mind.
Okay. Fantastic. I think we're more or less at the same place. We're trying to see how money makes our life better and if we can extend the longevity of its benefit to future generations. Okay. So I'll have my presentation in two parts. The first part will be on our personal finance. It's hard to think about business finance if you're not thinking about where you're at financially, because you need to be able to address your own personal financial needs, then you can be able to extend. And also when it comes to money, it's all about being a good steward. Money has absolutely no emotions. It's emotionless. If you don't treat it properly the way it's supposed to be treated, it grows wings and flies. If you know and understand it and appreciate the basic concepts about it, then you're able to accumulate it over time. So I'll share the first part of my presentation, which is on personal finance. And then at the tail end, I know there were some questions on the NSC. I'll be able to share what the NSC is doing for businesses such as yourselves, and also address the question of why should you be thinking about investing in the NSC now, even as prices are going down. It'll be a very interactive session, so I hope you have, I can see all of you are logged in. I'll probably ask you to do one exercise either on your laptop or on your phone so that we are all aligned. But nonetheless, I'll hope for it to be interactive. So feel free to jump in to ask questions. And if I talk about something that you already know, I think I can see Harriet's camera, not Harriet's photo on. Maybe she'll be the one to tell me, Mwalimu, that we've covered, so that I don't belabor on a point that's already been covered. I hope that's okay. That's okay. I need to hear your voices. It will be hard for me to have this conversation. In fact, I think your cameras should be on so that we can engage. Nagila, what do you think? I'm just talking to a blank screen. So no, I don't want to accept that. I think you're people who are out to do business, you're ready for this class. Let's put on our we can and let's engage. It's easier that way. I can say yes, thank you so much for so it's going to be an interactive and it's going to be a fun class. It's cold, so we have to make the most of each other's energy this morning. So, all right, let me then start sharing my presentation. Nagila, please allow me to share my screen.
Good, you're good to go.
Okay. I think you can see my screen.
Yes.
Okay, fantastic. So I'll just move this to the side. So we were discussing money. What does money look like to you? Sunset tears are rosy, that's A. Or you have a big house and a big car, that's B. Or you actually have cash in the bank. Or you have an even bigger house and more cars and you have a farm at the backyard. Maybe you can put out, is it A, B, C, D? What are you thinking about? What do you think about money and yourself in 10 or 15 years?
Choice.
C? Who's going for B? Okay, not to worry. I cannot hear, so I'm not discussing, but it's okay. So anyway,
Okay, we can see some.
Yes.
There is A, there is B, there is B. Mary says B, Deborah says A.
Okay.
Tech5 says B.
Okay.
Infinite says B.
Okay.
Elizabeth says A.
All
Myself A.
Okay.
Francis Mwendwa says A. Steve says C.
Oh,
Karen
nice.
A.
Okay.
Ingori and Becky, they say B. Joe Orlando, that's my pastor, B and C.
Yes.
Then we have Ken Ngome says A. Paul Kauku says B. Josephine says B. Washira says B. Good.
Oh, fantastic. So I can see if I started a car business, I'd have many buyers here because most people are on B and D. But I think for me, what I say it's C, because anytime you're doing your business or you're working or whatever it is that you're doing, you're generating cash. But if you don't have cash in the latter years, the thing that you always have to remember is the energy that you have today, you will not have in 15 years. So you have to find a way to make money work for you. What will be more important for you in your latter years is actually C, because when you're older, you're probably going to hospital more. You need a lot just to take care of yourself. And if it's not coming in, either from investments or from your businesses, then you end up being in a destitute situation. But let's see how we can move ourselves from B, D to probably the A and C regions. Now, when it comes to looking at wealth in Kenya, the first thing that you want to understand is what personal net worth is. I'll be explaining this in the subsequent slides. Let me just adjust my camera here. But when we talk about wealth, most people say that we are not wealthy because we don't feel like we have money. But the thing is, when you speak to people in Kenya, in Africa, and in other areas, you find that you're very wealthy because first and foremost, you already have maybe land somewhere that is sitting somewhere. Maybe you just haven't found a way to utilize it. But more importantly, if you're in Kenya and you have anything more than $20,000, which is about 2.5 million, and that's the cumulative value of maybe cash or maybe your car, maybe the house that you live in, maybe some land that you've bought as a group, some land that you've been given up country by your parents as an inheritance, you're actually wealthy. So when people say that I'm not wealthy, I'm probably living from hand to mouth, perhaps then the question is, what is in your mind? And are you focused on generating value from the assets that you have? In other words, when it comes to looking at your personal net worth, we start off by asking yourself, what assets do I have? In other words, what do I own as Nithe? Do I own a house? Do I own land? Do I own a car? What's the value of the money in my account? And then you deduct liabilities, what you owe other people. Do I owe other people by virtue of debt to a bank, debt to a circle, debt to my friends? If you deduct that from your assets, you actually get your net worth. When you're talking about personal finance, you want to start off by understanding your net worth because you need to know where am I at today so that you can articulate where you want to go into the future. Now, personal finance has different subsets. You can either be talking about tax planning, you can be thinking about insurance. What kind of insurance products do I need? You can be talking about investment planning, retirement planning, estate planning, or cash flow planning. So these are all the things I think that came out at the beginning when we're asking, what do you want cash for and what are you thinking about? There are different subsets that you need to consider even as you're doing your planning. And it's important to consider where you're at in each of this. I'll give an example. When it comes to insurance planning, people just go and buy an insurance product without paying attention to what product does this actually meet, what gap does it meet in my life. So you end up having an array of investment products or insurance products that may or may not necessarily help you address your future needs. So what I'm saying is when it comes to financial planning, it's your own personal plan. You need to understand where you're at, what your needs are, and then you plug into the market and say, what products will help me get to the place that I want to get into. Now, this is the most exciting part about today, the most engagement that we'll get from today. When it comes to financial independence, which is where we want to go, there are really 7 stages of how you can look at it. Financial dependency says that I depend on other people to pay my bills. Maybe I'm in school, maybe I'm a minor, so my parents are the ones that provide for me. Financial solvency means that you make enough money to pay your bills on time. I had someone saying that that's what they want to get to. There's financial stability, which is the second stage. You make payments on time and you have an emergency fund. Then you get to the level of debt freedom. I'm rid of 100% of my debt. It has been paid off. Then we start getting to the sweet spot, financial security, meaning that you have made investments and they cover for your survival. And we have financial independence. Then the final one is financial abundance. You have made so much money that you will never need anymore. I'd like us to go to menti.com. I think you can see it there. And I'd like us to enter that code. And I'd like us to take a vote and see where we are at so that we can get a sense of the room. Maybe, Nagila, I hope that's okay. So go to menti.com, put on the code 7929341, and let's get a sense of where we are at as a class today and where we'd like to get to. Then we can continue with the conversation. I'll stop sharing this. I'll stop sharing this screen. Then I'll go to menti.com. We can be able to take our answers. Menti.com. Harriet, I'm the only one. I can see you. So I don't know if you've already got. Yeah, menti.com. Enter the code. I can see Ed the DJ. Menti.com. Then the code is 7929341. Let's assess what stage of financial independence we are at. And don't worry, it's an anonymous poll, so it doesn't show any name. It'll just show us numbers, so don't be scared. Since we're about 50, I'll hope to see 50 responses at this point. Let me stop sharing, then I can go there. That's menti.com. All right, so I'm seeing the responses coming. Let me share my screen. All right, so I have a few, yes, I can see. Fantastic. So we can see financial dependency, you depend on somebody else, that's one. Oh, fantastic. We have someone who has more than enough, more than they will ever need. That's fantastic. Then the bulk of us are at the financial solvency stage, meaning that we're making enough money to pay our bills on time. I'd encourage us, just go onto menti.com. The code is 7929341. If we can do this as quickly as possible and see where we are at today and where we'd like to be tomorrow. right? The majority of us are able to make enough money to pay our bills on time. Then we have some of us who have extra money to make payments on time and have an emergency fund. That's fantastic. Then some of us are already free of debt. Some of us are making money from our investments to cover our current lifestyles. Some of us also have more money than we will ever need. All right, I'll give it a few more minutes. Just take the poll. It's anonymous, so we will not see any names. Don't be scared. It's just numbers. And then put in where you're at today so that we can get a sense of where we are at. And also, this is important to know. At times, you could be aspiring for something and wondering, will it ever happen? But I can see in this particular class, it's already happened, because most of us tend to want to aspire first and foremost to get to the element of free of debt. And then we want to now then start making investments to make a return so that we can cover our current lifestyles. And ultimately, we would hope to get to a space of financial abundance where you have more than you need to cover for yourself and for future generations. So I'll give it just 30 more seconds. I think I have, I'm probably half the class, maybe the rest of the other class, the other half. Most of us were still getting out and having coffee. Yeah. Okay. This is only we can interact because I can't hear your voices. If we were in a room, we would have just put our hands up. So it would be really good. And I'll share this now with you as a team. Okay. All right. So I'll close this poll at this time. So we do have the majority of us are at the element of financial solvency. That's stage 1, meaning that we're making enough money to pay our bills on time. Some of us are dependent on others. So this is a good space to be in so that you can learn how do you get to the next step. Some of us are able to make payments and have emergency funds, meaning we can save a bit more. Some of us are free of debt. This is a good space to be because debt is a huge burden for us in Kenya. Some of us have investments that cover our current lifestyles, and some of us have more money than we would ever need. So thank you so much for that. So I'll stop sharing this and then I'll go back now to our presentation. So then, the genesis of this presentation is this way. So you've already identified where you're at and where you would like to go. Now, we need to take a step back and understand, how do we look like on paper today? Really, what we are saying is the same way that auditors come in and look at a company's health, and at the end of the year, they tell you this is how you look like in terms of your assets and liabilities, and this is how much cash you generated over the year. Then we want to personalize this conversation and ask ourselves, how do I look like as a leader today? And if I was to audit myself, where am I at and what would I like to do? It's an easy way to be able to create targets for yourself and figure out what is important to you and what do you want to focus on. And for us, because we're halfway through the year, then you can articulate your goals for the next half of the year. Our starting point is personal net worth. And what personal net worth is, it's a measure of your personal financial wealth. It's calculated by subtracting your total assets from your total liabilities. In other words, what you own, and you deduct what you owe others to get your net worth. It can either be positive or it can be negative. A positive net worth means the assets that you own, whether it's your house, whether it's land, whether it's your car, anything that has your name to it is more than what you owe others. And what you owe others is primarily debt. And then a negative net worth means you owe others more than you own. And I know at this point, most people say, is a car an asset that earns me interest? And I say, let's park that conversation for now. But at this point, you want to compare what do I owe and what do I owe others and deduct from that. Then the next thing that you want to do is then look at the assets that you own and then ask yourself, am I making money from this or not? What you typically find is for people who have a positive net worth, the bulk of their assets are possibly in land or in cars. And what happens is as they get older and get into retirement, these assets are not giving them a return. So you find maybe 70% of someone's assets are a home that they have got, it's a mortgage, maybe there's a car, and there's some land that they're not farming. So what happens is you get these people are asset rich in their 60s and their 70s, but they can't afford even to buy milk or to just have your daily groceries or daily needs met. So what you need to focus on, if your net worth is positive, is your next question is, am I earning money from the assets that I own?
if I'm not earning money, then the question to ask yourself is, how can I start moving from assets that don't earn me money to assets that are earning me money? Then the second class of people are people who have a negative net worth. They've probably taken on a lot of debt, more than they could handle, or they took debt, maybe put it to a business, maybe the business did not go too well. So now they're unable to have assets being generated by the business, but they already have this huge liability by the in form of debt. I think maybe there's someone's mic that is on, or maybe that's my echo. Okay, no worries. So you probably find that if you have a negative net worth, you owe too much, and your focus needs to be, how do I bring down my debt? And especially for us in Kenya, because debt is so expensive, and I'll show you how it actually affects your ability to generate wealth. So what is important? Understand your current situation. Do this at least once a year, or possibly if you can do it on a quarterly basis, the merrier. How do we calculate this? Basically, what you do is you look at your assets, land and property, any investments that you have in bonds, in stocks, in the businesses that you own, any cash value of insurance that you've fully paid up for, retirement assets, people do have pension, then cash in your account, in your money market, in your mobile savings account. And there's some people who probably do farming. So the inputs from this, perhaps you have cattle, perhaps you have bags or bins of wheat, bags of maize, and bins. Maybe you can be able to actually adapt that. I think, Nagai, there's a bit of an echo. You'll probably help me understand whose mic is on and they can put it off. Thank you so much. Then on the other side is, asante sana. You want to deduct your liabilities. Liabilities is something that you owe other people. It could be a mortgage, it could be credit card debt, it could be personal loans, it could be life insurance policies that you've not paid up for, or it could be anything else. Anything that you owe other people, you want to deduct from your assets. So what I'd encourage you at this point, maybe you're on a laptop or you have a piece of paper, just don't overthink it. Just have a list, a column that shows you what are all my assets and put the estimated values. Then on the other side of the column, put your list of all your liabilities and then get the sum difference so that you're able to know, is my net worth positive? Is it negative? And maybe at this point in time, I'll stop sharing and just see if I can interact with the class. First and foremost, to get a sense of, is this a new concept? Is it something you've already done? Is it positive? Is it negative? Maybe I can get a few answers coming in from this. Silence is not golden in this session today. Yeah, you don't have to tell me your number, but I just want to get a sense of, is there something that you're doing? Does it make sense? Does it give you some new insight? Yeah. Positive. I can see from Lynette, everybody, that's positive. Thank you. Lynette, did you already know that? Had you done it before? Okay, so you've done it, so it's not new information. Thank you so much. Then the other question then from Lynette, if it's positive and Lisa it's positive, do you track it and do you put a target for yourself in terms of how you want it to grow? So for instance, for myself, I know I want it to grow by at least 20% every year. Do you put such targets and do you track it? Yes, I can see positives. Shida ni cash. Okay, all right. Okay, so I can see Eunice, it's negative. Okay, so Eunice, maybe this would be a good time to just review it and see. You learn that it's actually changed. Every time you track it, something always changes in your financial position. Okay, then so what now we need to focus on is at least do it and figure out if it's positive or negative. You need to track it at least twice a year, because if you don't track it, it's hard for your mind to figure out what you need to do. And then I like that someone has said it's positive, but there's no cash flow. So now your personal target becomes, how do I move from having assets that are more than liabilities to actually having assets that are earning me interest? And the importance of doing this is that when we start covering things such as investments and debts and budgets, it's personalized to you, because for the person who said they're not earning interest, then for them, they will be looking for what investment opportunities can earn me a return, and how do I then move any surplus cash I get into that point. Somebody says, positive, I started this year, and their focus has been on clearing on debt. All right, thank you so much for that. So now I'll go back and continue the conversation. All right, so once we do this is the first part of our conversation. Then the next thing is, how do we build our net worth? Without cash, there's nothing that you're doing. There's a reason that we hear statements that say cash is king. You need cash to build your net worth. If you have a negative net worth, it possibly means you've been borrowing a lot of money to fund whatever it is that you're funding. Now, there's nothing wrong with debt. It really just depends on what kind of debt you're taking and what you're taking it for. And maybe that's more of a personal decision or a business decision. But for our case, you need to focus on where is cash coming from, where is cash going? Because if you have cash coming in that's more than your expenses, it means every single time you have a surplus that you can actually deploy to build on your net assets. So what is personal cash flows? What we are really doing is we're looking at how much cash has come in, how much cash is going out. Now, the difference between the personal cash flows and the personal net worth is the net worth, you probably do it as a statement of time. If you do it today, you can probably do it in another 6 months. But for your personal cash flows, cash is coming in. At least every month, there's some cash that's coming in. Every day, there's cash that's going out. So you want to keep track on where's my cash coming in, where's my cash going, and what am I spending it on? The purpose of determining your cash flows and outflows is to find out what is my net cash position. A positive net cash flow means that you earned more than you spent in a given period. A negative cash flow means that you're spending more money than you're bringing in. Your net cash flow, it's a direct means of increasing your personal net worth. If you have a positive net cash flow, you can apply that money to acquiring assets or paying off liabilities. And I know one of us said the last time they did their personal net worth was 2 years ago. I'd encourage you to revisit it now because something has changed. If you probably had debt, you've been paying off your debt for the last 2 years, which means your debt situation has reduced and maybe your negative net worth is not as it was at the point of 2 years ago. So I'd encourage you to look at that. Then the final thing is when you apply your net cash flow toward your net worth, it's the easiest and greatest way of increasing your assets without necessarily taking on debt. So that's the element of the cash flows. And in other words, your cash flow is really just another restatement of your budgets. And this is how we look at it. On one side, you're asking yourself, where am I getting money from? So you could probably be earning a salary either from work or from your business, or you probably have a stipend that you get either from your work, from your business, or from the people who support you. Maybe you're in the business of selling assets. Maybe you sold something and you got money. There's business revenue. You got returns from assets. Maybe you earned dividends. Maybe you earned interest. Maybe you earned rental income from assets that you own. But the focus here is to diversify your revenue sources. What you tend to find here is most people have maybe one source of inflow, one or two at most. But it's very hard to grow your personal net worth and your wealth if you only rely on one source of income. So what we normally say in this area is appreciate and separate two sources of income. There's passive income and there's active income. Active income is the income that you get when you wake up every day. Am I going to my business every day? It pays me. That's active income. Am I going to work every day and I'm getting paid? That's active income. Active income requires you to be physically present. If you're not physically present, then you don't earn. So that's the typical things that we do every day. What's your constant every daily routine that you do to be able to earn money? Then the other way of earning is passive income, where you put your money away and it works for you. Passive income is you buy a house and you earn rent from it. You don't have to be there. As long as the house is occupied, it will generate rent. Passive income is you putting money into circles and earning from circles. Maybe you earn through the dividends that they pay. Passive income is putting your money into a fixed deposit account, into a money market account, and it keeps compounding and it keeps growing slowly by slowly. In other words, whether you are awake or asleep, your money is earning you something. And then the other way of earning it is learning how to build a good business that has its own structures so that whether you're there or not, the business is running. And I want to believe that's what you've been learning through this mentorship class of how do you build a business that is separate from you as an individual and it's able to generate benefit for yourself and all the stakeholders around because you've actually thought about what kind of systems do I need to create and how do I actually grow a business from being a sole proprietor to something that is independent of my time and my energy. Then on the other side of the chart, you have your outflows. So you are paying for your expenses. You're probably supporting people around you. You're having your savings. You have investments, and maybe you have your ad hoc expenses. Now, the thing about this, and I'm sure most of you already have your budgets, it's an interesting thing that you want to track at least once a month. But when you track it, at least when I track mine, every day I'm always making a payment, if not 2, if not 3. When you get towards the end of the month, like now, you find like you're probably making 5 payments a day. But then when I look at my inflows, my largest inflow comes from my salary. And then I'll have inflows that now come in maybe from rental income, from dividends, from interest. They don't come in every day. So my personal target becomes, how do I actually get a source of income that is passive, at least on a weekly basis? Because every single day, something you're spending on something. Inflation is always eating at us. Fuel is now over 150 shillings. And Meskia late, it's with the conversation of Beya Unga. In church on Sunday, we were told to discuss 20 marks, the cost of Unga, which means the cost of living has gone up. So there's always something that's deducted. So for me, then my personal goal becomes, how do I get to a point where, if not today, at least in year 5, at least in 10 years, where every day there's money coming in? That's now what I'm normally thinking about, how to diversify my revenue sources so that I can have money coming in. And then more importantly, because I do know by the grace of God, I'll probably grow old and I pray for long life. When I get older, how will I replace my salary, the money that's coming in today? Because I'll certainly not be doing the kind of work that I'm doing today. I won't have the energy for it. I won't be able to do the kind of productivity that I'm doing today. So I'm cognizant of that. And I'm constantly thinking, how do I have other revenue sources than replacing my main source of revenue today? So once again, I'll ask us just to do this, and I'm sure you're all good stewards of money. I'd like to just get a sense from the room. Is your cash flow positive? Is it negative? Are you doing this on a constant basis? And what are some of the things that are coming out in terms of what you need to focus on? So again, I'll stop sharing, then I'll go to the room. And I'm seeing I have 15 minutes, so I'll probably start winding up now. Yeah, any comments? Okay, no worries. Let me just go back to the presentation. Okay, so that's what you want to focus on. Then once you do that, you can do these exercises at your own free time. And I think you have a vibrant WhatsApp group you can discuss there with your partners. Then when it comes to how do you move forward is you want to focus on your budgets. You want to take a set of how much debt do I have? And I know what's normally a harder thing to do is most of you are probably running personal businesses where the business is not separate from your personal finances. There needs to be a separation of this. You want to look at your budgets, track your cash flow, understand your patterns of saving. I'll give you a quick tip. What happens here is when you look at people in their personal finance, people don't save, people don't invest, but we have a culture of supporting each other when it comes to funerals, when it comes to weddings, when it comes to people who are unwell. That is all good, and it's a very noble thing to do. But what I normally say is have a budget allocation. How much will I save as a percentage? Bare minimum 10%. How much will I invest? Bare minimum 10%. And then how much am I going to give? Have a budget target for that so that at least try and keep your expenses at 60% of your income or below so that you can be able to save more. Debt, you want to list all your debt. And then now, once you have been able to figure out how to deal with your debt, you can then come to investments. I think I'll just quickly flow through this because I've noticed I'm out of time. So really budgets, we've discussed that. You want to identify your patterns. It's hard to do this if you're not tracking. You want to prioritize your spending. Focus on needs versus wants. How we explain needs versus wants is very simple. And I'll use Nagilai as an example. Nagilai, there's Apple the fruit and Apple the phone. What is a need and what is a want? I can see you smiling, but I can't hear you. So there's Apple. I can have Apple for a fruit, or I can have Apple, an iPhone, a phone. What is a need there and what is a want? What do I need there on a daily basis? I don't know if you can hear me.
Yes, we can hear you.
Oh, yes. Okay, I can hear you now.
Yes. Okay, the fruit there is a need.
Okay.
Then the phone is a want. That's for me.
Thank you so much. And you're absolutely right. Now, the cost of the need is probably 40 shillings, isn't it? And then the cost of the want is over 100,000. So when it comes to spending, you have to be careful. What am I spending on? If you keep spending on your wants, you're really wasting your money. But if you focus on, I will only spend on my needs, and then I will spend on my wants in the future, then that's a better way of actually ensuring that you always have a surplus the end. So that's the big thing when it comes to budget. Then income, we've talked about this. There's the element of active income, passive income, and what are you necessarily doing? I'll just move this to the side again. So active is you're trading your time for your money. You have a job, it gives you money. Passive income, you're probably a business owner. You have figured out a system of making people work for you. And if you're like me, I was running a business that didn't go too well. Now I'm actually working for a business. So now for me, what I do is I look for businesses that I can invest in. And that's where the Nairobi Securities Exchange comes in, because it gives you a platform where you can look at businesses that are managing themselves well and are able to give you a return as a shareholder and putting your money in there. That ties in with being an investor, meaning money works for you, and then you're self-employed, you own your job. So you really want to move from the blue side of the circle to the green side. You want to have a business, other people working for you, or money working for you. That's the only way you can be able to generate wealth for yourself, at least in the long term. Then briefly on expenses, this is some of the rules that we've already had. And Nagilai, and I'll use you because I can see you and I know you. I think the things that I'm teaching today are not new. What tends to happen is we are not accountable to one another or to ourselves at a bare minimum in terms of living out the things that we do. You want to track your expenses. This is your basic rule of thumb. If you can spend at least 50% on your essentials, then savings and investments do 20%, discretionary 30%. It really is up to you. There's so many ways to skin the cat here when it comes to budgets, but what you always want to take out is you have to have an allocation for savings and investments. These handouts that you're constantly giving, you're not giving to yourself. And the only money that you keep for yourself when you earn is the money that you save and invest. Anything else that you consume, you take to the supermarkets or you take it to wherever else, it's not your money. It's money you're giving to somebody else. So the key takeout here is really you want to focus on your savings and investments, and you want to save as much as you can. If you have debt, I think I saw some of us have debt. One of us got out of debt. That's a good thing. You want to see how you want to list down all your debt and the cost of that debt. So most of us take debt because it's accessible to us, maybe through the phone. I'd like you to ask yourself, if you have debt, how much are you paying for that debt? You know, the standard cost of debt now is about 12.2, 12.3% in Kenya. I'll show you a slide that shows you that getting an investment return of that amount, if it's not your business, it's really hard to get that kind of return. So you want to ask yourself, what's the element of my debt and what's the cost of that debt? Then you want to look at debt strategies of how can I be able to think about my debt and clear it. So I'll share this presentation with Nagilai just for you, but I wanted to now just get to the latter part of this presentation and tell you that when it comes to thinking about your future, this is how your life looks like. You start off as a teenager, you're in your 20s, you're in your 30s, you get to your 50s. The reality is you'll probably get to the age of 80. At least there's a 70% chance that a good number of us here will get to the age of 80. We don't like paying attention to that, but what I'll ask you to do is to do at least 80 minus your age, so that you know how many more years you have. Since I can see Harriet, I'll just ask her to do 80 minus her age. You don't need to tell me. You can put, what is 80 minus your age? Put it on the chart so that we know how many years you're planning for. So for instance, for me, this is a good year. I'm turning a good age. So I have 40 years to think about for my own planning. 40 years of thinking about myself, 40 years of thinking about how will my family be provided for, 40 years of thinking how will I provide for my future self, and 40 years of thinking how will I provide for the future generations. So when I look at it like that, I don't focus on what has happened in the past. My mind is like, oh my goodness, what am I going to do financially for the next 40 years? So maybe you can put it up on the charts. What's your planning horizon? And I find that when I do that, then it really jumps at me and I'm like, my goodness, I'm not just making day-to-day decisions of how will I pay for my milk, how will I pay for my rent. I really have to expand my thinking capacity to how will I think for the next 40 years. If you're building businesses and you want to hand these businesses over to your future generations, then maybe that thinking needs to expand to the next 100 years. So what am I building today? How am I going to ensure it has a foundation for the next 100 years? How will I sustain it? How will it pay for itself? So that's the thinking about it. And when you're thinking in that sense, then the conversation on retirement planning, it's not a place I'll get to when I turn 60 or 70. It's a mindset of how will I ensure that those latter years are well provided for, and how do I make the most of the financial resources that come my way? And more importantly, can I be smarter when it comes to my earning capacity? You don't have control over your expenses. Those keep rising, especially for your needs, but you do have control of asking yourself, am I okay with the income that comes in, or what else can I do to increase that income? Then I think for us, you have to actually constantly think about it and figuring out how much is enough. Now, the interesting thing about Kenya today is that only 15% of the workforce is covered by pension. So if you're running businesses, no one is actively thinking about your retirement and putting money aside. It's your responsibility to start doing that for yourself. There are many pension funds that are available out there. At a bare minimum, I say put 10% aside of your salary or irregular earnings on a monthly basis and put it now into an investment vehicle that can invest for you in the long term. You want to be able to look for something that has 10 years or 15 years. And really the item that you want to look at is really infrastructure bonds. These are tax-free. You put your money there for 15 years or more. So you're constantly looking for an infrastructure bond to put money, because that money, you won't access it and you can access it in the future when you need it. So that's really what you're looking at. Now let's get into the part of investments, and I come to almost the tail end of my conversation. Now, when it comes to planning, sorry, I've just jumped a slide. Sorry. Okay, so when you're looking about investments, you want to always put in mind that there's a risk for every return you're making. There's low risk, low return, high risk, high return. If I tell you I'm going to give you 100% and you want to put your money there, if I tell you I'll double your money tomorrow, you better be sure that and comfortable that if you don't get your money tomorrow, you'll be able to survive. So what we normally say, low return, low risk is the money market and treasury bonds, Government of Kenya investment bonds. Those are normally low risk because the risk of you losing your money, it's pretty low. But that also means that their return is also low. What I normally say is if you're accumulating and starting to build your wealth, start off with low risk, low return. So for instance, start off with $1 million in either a money market or in a Government of Kenya bond. And then if you make a return of say 10%, which is 100,000, take it to the next class. So if you make 100,000 and maybe you put it in stocks, or you put it in a business and you're not, or a startup business and it doesn't make you money, in case you lose it, you're only losing 100,000. But don't start by putting your 1 million in something that is very risky, because there's a high chance that you could lose your 1 million. The thing about wealth, always defend your bottom. It's like building a house, have a strong foundation, and then keep going to the additional classes over time. Now, what you want to focus on is, where are you at? This, I think you'll be able to evaluate on your own time. And then there's some strategies there that help you figure out how to get there. But let me now come to investments and what we've seen. So most of you are probably investing a lot of money into your businesses. I have run a business before and I know how much capital it needs. If you're running your business alone, I would hope that as you finish this mentorship class, you can find other people to co-invest with you and share that burden, because a business needs a lot of capital to be able to stand on its own self. Now, if you have some surplus funds, your question is then, where do I put money if I'm looking for a return in Kenya? I wanted to just show this allocation of assets for Kenyan pension funds over time. I need to update this, but the bulk of assets for pension funds, which are managed by professionals and which have a total value of 1.5 trillion, are actually in fixed income. And what we are seeing is that these professionals are saying they're putting money into investments that give them a guaranteed return year in, year out. Then equities, they've put in about 18.9%. Property is about 5.7%. So I use this and I say you probably want to use this as a proxy of how you're allocating your. Try and see if you can put investments into something that gives you returns. That's government bonds, that's money market bonds, but also put some assets into stocks. And this is what the NSE does for you, because the NSE does create value for you. And I had somebody ask, is this the right time to be buying stocks? Yes, it is, because the stocks have actually come down in terms of price. So the prices are down. There will be an expectation for a recovery that you want to focus on that at this point in time. And then finally, just looking at asset returns. So what tends to happen is your lending rate is about 12.2%, but the bulk of the investment opportunities you have outside of your business, that is, are actually giving you less than 12% return. So what happens is if your focus is on borrowing to build wealth, then you might not build wealth because you might be building wealth for the back. But if your focus is you want to borrow and build a business, I know in business you can even sell your wares at double the price, then that's a very good business. But when it comes to passive income, you can see your savings account is at about 2.5%. Then you have real estate returns are at about 6%, 8%, depending on where you're at. Inflation has adjusted now. Inflation is at 7.1%. Deposit rates are giving you 6.3%. The rule of thumb is when it comes to investments, let an investment give you a return that's higher than the inflation rate, which is 7%. So that has to be your hurdle rate. Then the next thing, let it give you a return that's higher than your cost of money. If your cost of money is zero, meaning that you've been saving it, that's the best way to be able to deploy money into wealth. If you have to borrow to invest and you borrow at maybe 12.5% and invest at 10%, you're already underwater because you constantly have to look for extra income to make that return for you. So the question is, do you want to make a return for a debt provider or do you want to make a return for yourself? We have good returns in Kenya. This is comparing with what's happening in other regions. Of course, Zambia and Ghana saw better returns when it came to shares, at least at the end of last year. Our returns in Kenya are negative for this year. But then what that means is there's an opportunity for you to actually look and find investment opportunities to actually collect assets at this time. Now, I'll just spend the next 2 minutes taking you through an overview of what's happening at the NSC so that you can be well acquainted with why are we saying that the NSC needs to be something to focus on at this point in time. So I'll share just 2 more slides with you to give you a sense of what is happening in our market, and then we can be able to close off and take a question and answer session. Just give me a minute. So as I'm opening up my other presentation, maybe, are there any comments, questions? Is there something that you'd like me to also focus on as I come to the tail end?
I think we have a comment, which is a good comment from Jen Wangare. She says, is there a part 2 of this?
I know I've rushed. Sorry, I was just trying to give the highlights, but Nagilai will probably be better placed to tell us.
Then we have Lisa is asking, are we productive after 60s?
Mm-hmm. That's a good question. Your body cannot do what you're doing now. Let me reverse it. What I'm doing today, I could not, what I was doing 10 years ago, I don't have the energy for it. Like there's a time when I started working, which was about 15 years ago, I could work and function with sleep of 3 hours a day in a week. I tell you, I do that now, Nagilai, my goodness. By Friday, I'm like, I have to sleep for 2 days just to recover. So your body is going to run out. That's just the way nature is. That's just how we are created. That's just how we are created. So you have, if you already accept that, then it's easier for you then to ask yourself, okay, maybe I've not been taking care of my finances because I've been imagining my body will not change. But how do I then now start paying attention and putting money aside into spaces where I can be able to make a return? All right, so let me now share this final part of the presentation. Okay, so I hope you can see that. Let me put this in presentation mode. So now when it comes to shares, you want to be looking at shares if you have surplus capital and if you want to make a return. But even before I delve into that, let me just share about who we are at the Nairobi Securities Exchange. So we have 3.4 trillion in terms of assets that we've been able to generate for bonds. And when it comes to the money, to the equities, the shares that are listed, which are 62, we have value of 1.08 trillion. The available products are equities, we have real estate investment trusts, we have ETFs, we have training, we have derivatives, we have data, bonds, and Akiba, and Ibuka. Now, when you look at our environment today, where we are at as Kenya, our expected GDP is 6%, The inflation as at end of May was 7.08. We're waiting for June, which ends today. And then the central bank rate is 7.5%. And put this at the bottom. Now, I wanted to just show an overview of what is happening in our markets. So that is what is happening in our markets. And we've been tracking it. We have a tracker from 2020 to date. So turnover has certainly come off from last year to this year. And what we've seen is a loss of market price value for the shares. What is happening is globally and locally, sentiment has been a bit adverse, largely because of what is happening with the upcoming elections and also currency and oil prices surging. What that means is that our market has two elements. There's the fundamental value, the value that the businesses bring to the table, but there's also an element of demand and supply. I'm sure most of you are in the business of buying and selling goods. You could have a fantastic product, and I'll use the case of Optiven. Optiven could have prime property that they want to sell, but because of forces that are beyond Optiven, they could be in a space where the demand for that property does not even match the value of that property. Nagila, is that a good way of looking at it? Because there are times that you go through, people actually don't have money to buy it, but that does not mean that the land that you're selling is not valuable, isn't it?
Yes, it is.
Yes, so that's the same thing that happens with the stocks, because the stocks that are on the NSE actually have value, but what happens because of demand and supply and for factors that are beyond the market, you find that the demand is not reflecting the value on the market. So today we have a market that's trading at 8.9 times price to earnings ratio, and this has been coming off as prices have been coming off. So we have an entity that has largely many assets that are available to you as an entity, and it's a good time to look at it. But what I also wanted to focus on is a platform that we've actually produced for SMEs, and this is the unquoted securities platform. So what we've done as the Nairobi Securities Exchange, over and above providing you access to equities, is what we've said is we want to tap into the small and to the medium enterprise market space and see how do we fund these businesses. So we have the unquoted securities platform that then allows you to come into the market before you get into the main market to appreciate how can you raise capital. This has been an interesting platform for us. We've seen a business trade almost R1 billion worth of shares in the last 1 year alone. So even as you're building your businesses, a very direct way of you to actually create wealth is to actually find a way to structure your shares and be able to sell them. If you're able to sell, you create wealth for yourself. Now I'll share my final slide on this particular page, and then I can be able to take a question and answer to show you what happens in Kenya, because we are in a space where we are highly leveraged, depend a lot on debt. And then the question is normally, how do I create value for myself as an owner of a business? Or how do I tap into somebody else's business and create value for myself? Largely, that can only be done through shares and the value that's created by shares. So let me share that last slide, and then now I can be able to take questions and then close it at this point. And I really hope that I've left you with something to think about, because when it comes to money, there's so many things that you need to focus on. And I hear some of you then asking for a second session. And what I would say then is maybe there needs to be a conversation on what do we need to prioritize on and what can we then flesh out on, so that today was really just a taste of what happens in our markets, what opportunities are available to you. And I'd be more than happy to have a full-on conversation that then focuses on one topic and carries it on thereafter. Now, this is the market performance during election years. Every time we get into an election, the market actually becomes muted with regards to activity. The blue line represents the turnover for equities. The green line represents turnover for bonds. Every single election cycle, our turnover for equities, it comes down. The prices come down, and people say, is it the end? Like, it's not the end. It happened in 2013, happened in 2017, is happening in 2022. When the prices are low for anything in your market and there's good value, you go and buy it because it creates value for you in the future. So what we've been saying is, yes, our market is trading at 8.9 times. There are people who've been selling out, but then the value of the underlying entities still remains. So it's up to you to pick and choose what entities make sense for you at this point in time. And then the other thing that I wanted now to be able to share was to say that as a market, there has been about 3.2 trillion that has been loaned out by the banking institutions in Kenya. For us as a market, as the NSC, we have created value of 1.8 trillion shillings for shareholders. So the choice for you is, do I want to unearth value by being a shareholder and creating value for myself? Do I want to find a way to engage and allow other people to be investors in my company and create value for them? Or do I want to just constantly be in a debt cycle where I'm creating value for bondholders? So I think that's the way to look at it from a business perspective and from an NSC perspective. I do hope I've been able to answer your questions. And even as I come to the tail end, one of my colleagues here is called Jackson. He wasn't able to make it. He did tell me that he has a class that he does on NSC shares. If you want to understand trading, if you want to understand financial literacy, I'm happy to share these posters with Nagilai. It's a very affordable course that just helps you understand how should I have my mind thinking about shares specifically, and how do I tap into the opportunities that they present. Nagila, I hope that I've been able to answer you. I know I've been a bit broad, but at least I hope I've been able to share snippets. Let me hand it back to you, then I can take a question and answer, and I can be guided from here on. Thank you so much for your time, and back to you.
Wow. Wow. That was awesome. That was great. We really appreciate you being there for taking us through this great topic. I can see people are appreciating. And yeah, we thank God that you came today, because quite a number of people have been able to learn to an extent that we have people asking for session 2 or part 2 of this. But we have some questions. Let me just read them through so that we can quickly answer them. Our time is quite much spent. We have Ajuna Wilson from Uganda. He says, what is the probable investment strategies? What is the probable investment strategies for young entrepreneurs with small cash flows? Then we have Kingori and Bechi. They're asking, advise more on money markets and favorable companies to deal with. Then another one from Joe. He says, a question on personal finance. Please compare and contrast and advice on investing in cash, salary replacement insurance policies versus investing in NSE. Okay, maybe you can take those ones because we have quite a number of questions. You can unmute yourself, sorry.
Thank you so much for those questions. So as I answer that, I just, this is the slide that I wanted to leave with you as a parting shot in terms of the value that we've created. So I'll just leave that there. So when it comes to what investment is right for you, I want to look at investment like building a house. You start off with a foundation, then you put the pillars, and then you put all the other floors if you want to go higher up, isn't it? So when it comes to your investment decisions, it's also important for you to start at the bottom and you go up. Key thing for you is always remember risk versus return. So if you're new at putting money aside for investments, you want to start off at a money market level, because that's low risk, low return. That's money market or government of Kenya bonds. That is where you want to start off at. Then the next level, once you make money from that, you allocate that money you've made into higher risk, into opportunities that are slightly more riskier, but give you a higher return. That's where now stocks come in. And stocks come in now at this point when they're low, you're saying the market is at 8.9 times PE ratio. What then opportunities of the 62 make sense to me? So at that point, then you go and talk to a transaction advisor. We have 23 licensed entities by the Capital Markets Authority, and these are investment banks. These are also stockbrokers. You can actually find a list of this on the NSC app. So you can download NSC app, and that's NSE APP app from my store or from the Play Store or from your iOS phone, depending on where you're at, to see who are these advisors. If you have an account, go back, because the transaction advisors, the market intermediaries, then do research for you, and they help you understand what are the right stocks for you at this point in time. So they're able to guide you. How do I then allocate money into the stock market at this point in time? But how I would like to look at it is, as an individual, whether you're starting as a small business today or a big business, what is important is first look at your net worth, look at your cash flows to understand where are you at, and then prioritize. For the next 6 months, will I want to prioritize on debt? Or for the next 6 months, do I want to prioritize on investments? Do I want to first have a money market? If I already have a money market, do I then want now to look at shares? And how do I look at shares? Talk to your transaction advisors. They are very more than well placed to be able to help you with that. And also you can talk to us by coming to one of our classes so that we can help you and empower you. But what I'm trying to say is, Nagilai, I think it's okay for us to ask other people what we need to do, but there's also a mindset shift that needs to come in where we say, I need to own, and where is the gap in knowledge? Where is the gap in information? How do I bridge that gap so that I own my decision? Because unfortunately, whether you make money or you lose money, the person who feels that pinch is you, the person who actually has that wallet to open or close, depending on whether it was a good year or a bad year for you. I hope that gives an overview of, at least answers those questions.
Oh, wow. Thank you. Thank you. Thank you, Mbide. We really appreciate you. And I'd like to, as we bring this to a conclusion, I can see very good comments. People are appreciating you, great information. Thank you. This session has been very informative. Thank you. Then wonderful session, excellent and very informative session. Thank you, Mbide. Very informative. Then we have excellent presentation, very informative. Thanks, Mbide. Then we have, thank you so much, Mbide, for your wonderful session. Then we have thanks so much for our mentor, Madam Mwema, for this powerful session and also engaging us fully. It keeps us awake and on toes. Thank you, thank you, thank you, thank you, teams, members of George Washuri School of Mentorship. We really appreciate you for being here today. I had seen our mentor at some point. I'd like him to say hi if he's still around before we call it a day. It's usually a 1-hour session. So today we've just extended because we had a guest. Sir, are you there?
Yes. Wow. It was a fantastic presentation. And we must thank our friend. I must thank our friend Mbide Mwema. That was a great presentation. And I'm sure that all the students have learned something. Tunasema asante sana. And I can see people demanding for part 2. So this is service to the community. So you are doing a good job. So we are very thankful. We are very, very grateful. Asante sana.
Awesome. Thank you. Thank you, sir. We appreciate you for giving us this platform and even being our mentor. We say a big thank you. And also we want to appreciate you, Mbide, for in a special way for just being here today. And I'd like to tell this to all mentees that we can organize the next session. However, we can organize it in the cohort 4. We are actually in cohort 3. So we can work with Ms. Mbide so that we can come up with a topic. Then we give her a topic in cohort 4. So today, without much ado, I just want to say a big thank you to each and every member who was able to tune in and to log in. We thank you for asking questions. The questions that have not been answered, definitely I will send them to Madam Mbide so that she can answer them, and then I will share in the group. So thank you so much. God bless you. And this session is officially adjourned. Asante sana. God bless you.